So with all the chaos in the world, why are investors in Singapore looking past the usual safe bets and piling their cash into, well, kind of boring industrial buildings? There's a fascinating story playing out in the Singapore stock market right now, and honestly, it might change how you think about finding shelter in a storm. Let's dig in.
Okay, so it all kicked off on February 28, 2026. A new conflict in the Middle East sends this immediate shockwave through the global economy. And you know what that means? Oil. It surges past $100 a barrel. Almost overnight, markets everywhere are just a sea of red. But while all that fear was spreading, something really strange was happening right here in Singapore.
Get this, a flood of money. We're talking over $638 million poured into Singapore stocks. And this wasn't the big institutional players. Nope. This was coming from everyday retail investors. They decided that while the rest of the world was selling, they were going to buy.
And that brings us to the core question of this whole explainer. In a market totally gripped by fear, with red arrows everywhere you look, why are thousands of regular investors making this massive debt on Singapore? And more specifically, on real estate of all things?
To figure out their logic, we first have to look at the other side of the trade, right? We have to understand why the big professional money managers seem to be running for the hills. And to be fair, their argument makes a lot of sense.
Now, what's really cool is how this slide just maps out the whole chain reaction. It's like dominoes. The conflict messes with the oil supply, which makes energy prices spike, which of course fuels inflation. So to fight that inflation, central banks have no choice but to keep interest rates high. And for real estate investment trusts, or REITs, companies that own buildings and rely on debt to grow, high interest rates are killer. It means their borrowing costs go up, their profits go down, and their unit prices fall. It's a straight line from that conflict zone right to a REIT's bottom line.
And the numbers show this logic playing out perfectly. In March, the main S-REIT index dropped a staggering 7%. That's more than 3 times the drop of the broader Singapore market, which only fell about 2%. So, yeah, S-REITs were getting hammered.
And this tells you exactly who was doing all the selling. Institutional investors, the big funds, the pros. They pulled a net $225 million out of S-REITs in March alone. The so-called smart money saw that chain reaction coming and decided, we're out of here.
But that's only half the story, isn't it? Because while all those institutions were selling, retail investors were making that massive $600 million bet in the other direction. What on earth are they seeing that the professionals are missing?
It really just boils down to 2 completely different ways of looking at the exact same set of facts. The institutions see higher risk and painful interest rates, which makes REITs a terrible bet. But retail investors, they see that same price drop and they call it something else entirely. A bargain. A chance to buy really high-quality assets on sale.
And you know what? They're not just making this up. As recently as March 25th, the Asia-Pacific Real Assets Association came out and said they expect REITs to stay resilient, even calling them safe haven income assets. That's a huge stamp of approval for what the retail crowd is thinking.
And let's be clear, this isn't just some random panic buying. It is a deliberate, thought-out strategy. The data shows that the stocks most bought by retail investors in March had fallen by an average of almost 8%. They are systematically going after the very things that have been beaten down the most.
So who's right? The big institutions or this retail army? Well, here's the twist. The answer might be that they're both kind of right. Because not all REITs are built to survive this kind of storm. The real key here is learning to tell them apart.
And this is the most crucial point of all. You just can't paint the entire S-REIT market with one single brush. It's not about buying any REIT right now. It's about finding the ones that are like fortresses, the ones that can actually weather this storm.
This table does a great job of breaking it down. On one side, you've got your vulnerable REITs. These are the ones with tons of debt, what they call high gearing, which is basically just a ratio of debt to their assets. They might also have a lot of exposure to struggling overseas markets and have big loans that need to be refinanced soon at these new, higher rates. But then you have the fortress REITs. They've got low debt, they're focused on the stable Singapore market, and they own property in resilient sectors like industrial buildings and, importantly, data centers.
And if you look at where that retail money is actually flowing, guess what? It lines up perfectly with this fortress profile. The top buys include names like Capitolana Ascendus REIT, Mapletree Industrial Trust, and Keppel DC REIT. These aren't random stabs in the dark. They are specific bets on industrial spaces and data centers, sectors that are seen as essential, even if the global economy takes a nosedive.
So, does this contrarian bet actually make financial sense? Let's get down to it and look at the simple, powerful numbers that really make the case for these fortress REITs.
And here it is. This chart just illustrates the main attraction perfectly. After all those price drops, the expected dividend yield on S-REITs is now sitting around 5.7%. Now compare that to the super safe 10-year Singapore government bond, which gives you just 2%. That gap between them, the spread, is 3.7 percentage points. That is wider than it usually is. For anyone looking for income, that is an incredibly attractive deal. You're getting paid way more to take on the property risk.
Which really leaves us with this final thought. In a world where shocks like this can rewrite the market rules in an instant, the big money consensus is to sell. But hundreds of millions of dollars are betting they're dead wrong. It really makes you wonder, in a world that's changing this fast, maybe the biggest risk of all is just following the crowd.